So welcome into the Free Stocks I'm Buying September 2023 edition. This is where I go over what stocks I've been buying and selling between the 1st of August and the 1st of September, just to keep up that transparency so you guys know what moves I'm making in the market. I didn't sell any stocks in the month of September, so there's only buy-in, and I only bought free stocks. So I was a little bit slower buying. The reason why is just because the S&P was quite strong through July and into August. Eventually in August, we did start to see the drop in a lot of stocks in the S&P 500. So started to see a few more opportunities then, but as I said, I'm a little bit slower buying at the moment. So yeah, I did only buy free stocks, and I'll go through these free stocks. I'll do my UK one in a few days time. There was a bit more buying on the UK side, and there was actually a bit of a sell going on the UK side as well. So I'll do that one next week for you guys. But here are the moves I made on the US side. So let's get started. And as always, if you do want to join the Patreon, it's only £5 a month. You can support the channel through there, so I can give you guys 5-6 videos a week on the YouTube. And in return for joining the Patreon and supporting the channel for £5 a month, you get 2 exclusive videos a week on there. One of them was the US portfolio review for August, and you can see how the US portfolio is going, and also a Discord with 500 members on to talk about stocks, including myself. So if you do want to join that, link is in the description. But let's get on to the first stock. So the first stock is PayPal. So PayPal, obviously 67 million market cap, currently traded in at 17 times earnings, $61. It's been a tough time for PayPal. I'm sure most of you guys are aware about this. It's one of the most talked about stocks at the moment. It's like Marmite. Either you love it or you hate it. It's you're on either side of the PayPal at the moment. You're either a big buyer, or you're saying you can understand why it's down and it's going to go lower. I've heard people say it's going to go to $40, $30. So it peaked at around 2021, around $275, and I've got to say I did think PayPal was overvalued in that time frame. But the reality check that it's been on now is just absolutely crazy. You know, it's down nearly 77%. You know, I know a lot of people talk about in that 2021 time period about, you know, a lot of stocks went to, you know, really crazy valuations, and they did go to crazy valuations. But you always refer to like the kind of higher risk growth stocks, or the hype stocks that were in that time frame. But here we are talking about a 60 billion market cap that's been crushed 77%, and it shows you that even some of those big blue chip stocks, even they can have a fair pain on the share price when they want to nosedive. But yeah, it went all the way from, you know, that $200, $300 all the way down to $100, and then it went even lower through 2022 and into 2023. And I have become a shareholder. I think I first started buying the stock maybe at like the back end of 2022. I think I was in at like $90, $80, and since that time frame I've been averaging down on this position and trying to buy more and more shares, and now it just keeps going low. I'm buying, and the more it gets lower, I'm seeing more upside, which I'm loving, and then because of that I'm actually trying to make this a larger position at the moment. And I also wanted to put into context like how much PayPal has actually been hurt right now. So this is actually Q1's financial 23 income statement for PayPal, and you can see here that PayPal and Venmo, a lot of people forget that PayPal actually own Venmo, which obviously is a fast growing peer-to-peer platform. PayPal and Venmo are doing obviously still quite decent. They've also got other value added services, which are the likes of Braintree, for example, and that's actually growing 39% year over year, and people actually don't realize that part of the business is still growing quite rapid at the moment. But overall, you'll see that revenue is 7 billion, growing at 9% a year. Now, just to put that into context, MasterCard, who in their recent quarter did 6.3 billion, they are, obviously everyone loves MasterCard, but they are roughly around about the same, give or take, the same size company, obviously, on a revenue point of view. Obviously, MasterCard, obviously, you'd say is a bit of a stronger moat, obviously, makes a little bit more better margins than PayPal. But just to put that into kind of context, that means PayPal is a 67 billion market cap company, but MasterCard is a 383 billion market cap company. And it shows you the difference. Obviously, there's a few little differences inside the company you can argue, and that's why MasterCard is a lot higher of a market cap company, but it just shows you like the revenue comparison there and the size different on the market cap, which is crazy. Now, PayPal on the recent earnings, I was actually quite impressed with their recent earnings. That paywall from Seeking Alpha got me again there. PayPal in the recent quarter, I thought was actually pretty good. EPS came in line, revenue grew 7.4%, the beat by 30 million. The guidance still looks pretty solid. They said they're going to do 5 billion of share buybacks. They said that actually July was very strong. They saw July's revenue coming at 9%. I thought this was really decent earnings from PayPal, and obviously considering as well, PayPal are, going back to good amounts of profit, focusing on profitability, focusing on free cash flow. That's going to allow them to buy back 5 billion in share buybacks as well. I was like, this is, so good for the company. And yet when the company brought out earnings, the company actually dived. This is the point where earnings came out. You can see the stock is down 18% from them earnings. I'd say, okay, worst case scenario, you'd say they're okay earnings, and maybe the stock deserves to be, where it was before this, which was $75. Like, worst case scenario, you say they're okay earnings, but the fact that it dropped 18% on these numbers, I just couldn't believe it. And then I was thinking, one of the things that will maybe putting people off from this company is there's going to be a change in the management team, and maybe people are a bit worried, what's the CEO that comes in. Obviously, they've announced a new CEO now recently, which is going to be Alex Chris from Intuit, which looks a pretty good appointment to me when you look at his background. And same again, you're like thinking, okay, he can put the company into a good direction for the next kind of 10 years. He's got a good customer base, the products that they're kind of adding now, takeover from Dan Schulman, and I thought that's probably one of the big things that's maybe holding the stock back, and even this hasn't made any difference to the share price. And then I'm looking at PayPal from a valuation point of view. The company at the moment on a forward basis, because obviously people, this is what I was saying about PayPal only a couple of months ago. People were looking at PayPal at 34 times earnings going, oh, it's still expensive though, but not realising the focus on profitability is going to be coming in the next 12 months. And that's starting to be shown now because it's now at 17 times earnings. But actually in a couple more quarters, it's going to get even better, and it's actually going to be down at 12 times forward earnings. 12 times forward earnings for a company that's about to buy 5 billion back in shares, that is growing at 7% in this quarter, just come off 9% growth in July. I'm shocked to see a higher quality business like that low, like below even a market average. For me, this is a premium company. Never mind a market average company, but it's not even trading at market average prices. 12 times earnings is below the market average that the S&P trades at 20 times earnings. For me, this is at least a market average company. Even if you're bearish on PayPal, I'm sure you could say that, okay, I don't agree it's a premium company, but at least it's an average company with that amount of growth and that profitability and that free cash flow and buying back that amount of shares. I just can't understand it. I think even the bearish people on PayPal must argue now that it's undervalued. And to put that into context, when this does drop down to 12 times earnings in a few quarters time, just to look at the history, I know people say, well, it's not growing as quick as what it was previously. I take that into consideration, but even then, you talk about 36 times earnings, 48 times earnings, 60 times earnings. I mean, even if you say that it's nowhere near what it used to trade at on a valuation basis, even if you go 20 times earnings, and that's not even factoring any growth, there's still upside from here. So yeah, I think this is the thing for PayPal. Like, even for me, I look at this and this is why I'm quite confident to buy this and build it up into a quite a big position in my portfolio, is that I go worst case scenario, I still think I make a lot of money on this. And then if it goes to the best case scenario, as you guys would have seen in the separate PayPal video I did maybe a week ago, I still make a lot of money from it. So yeah, that's why I got a lot of confidence to kind of buy this one up at the moment. So that's the first one, which is PayPal. Getting on to stock 2 is Hims and Hers. So I did not think I would see Hims and Hers back down at these prices, but we're here. We're back in the $6 range. And ultimately, the big question I have now is like, how much do I buy of Hims and Hers? That's the big thing I'm kind of considering. Like, I realized when we got to $12, I was like, personally for me, as you guys know, I took a little bit of profit off the table because I thought, okay, it's been on a good run. You never know, we might have a pullback now because we've been on a good run. Few people take a bit of profit. Some people were buying in that $3 range only 6 months ago. Some of them people are sitting up 100+ % on their positions. Maybe there's a bit of profit taken on here, and that profit taken looks like it did start to come into the stock, and I thought fair enough. Even I took a bit of profit off the table there. What I didn't expect this company to do is then actually drop nearly 41%. That's absolutely crazy. And now I've got to the position again where I never thought I'd see it at these sort of values again, and I'm thinking, how much do I buy of Hims and Hers? Like, can I justify the risk of putting Hims and Hers is my biggest position? That's what I'm kind of weighing up now, because I think this is a golden opportunity. I thought we might see the days of $9, $8 again. I didn't think we would see $6. And just to show you how crazy it is to see Hims and Hers back down at these sort of levels, Obviously, most of you guys will know the products that they do. Obviously, you will know that they're working on the new products, adding in, the likes of mental health, the new announcement of going into the weight loss category. As they kind of add into this more categories, obviously that gives them, as a telehealth service, potential to cross-sell more products to their user base. And just adding in, there's so much potential for this company in the healthcare market. Just adding in the weight loss part of the business. Just to give you an idea, the TAM is currently worth 224 billion. So, even if you say not even 10%, if they take 1% of the weight loss market, that is double the current revenue they do. So it shows you the potential. I mean, by 2030, their estimations is that it's going to be a 405 billion TAM. Same again, if you take 1% of that market share, you're going to be talking 4 times the revenue they currently do. So the healthcare area is such a big area, and they're only scratching the surface and doing fantastic. They have plenty more products they can move into, and this is the great thing. That people are worried, what happens if one thing happens to a certain sector they're in? What happens if something happens to ED? That is a concern, but the more this company matures and adds in more and more areas into the business, that risk of, if that happens to that product in the business, they're going to have plenty more to add in. And you can see here the prospective markets are looking to add in pain management, fertility, diabetes. They're just scratching the surface, guys, and that's the really scary thing when you look at Hims and Hers. And like I said, the company itself, fantastic earnings. They've just come off a EPS beat. They just grew 83% year over year. Not forgetting a year ago, they were only supposed to grow 20% this year, and they're growing 83%, and they beat by nearly 3 million. Subscribers up 74%. They did an outlook hike as well. They hiked up the revenue, they hiked up the adjusted EBITDA. And yet, since the 7th of August, when this company brought out this earnings, the stock actually reacted positive on it. The stock was up I think it was 17% on the day after it reported earnings, and for some reason that is unclear, the stock has now dropped 12%. On those earnings, the company has now had nearly a 30% swing on those earnings, which I just can't get my head around why that is happening. It's scary. And it's not even from a valuation point of view. I was talking about this on the Discord the other day, and I was saying, a really popular stock out there at the moment is this stock here, which I'm not even going to attempt to say. But this is a 25 billion market cap company for this growth stock here. And this company is, in my opinion, it's doing all right. You look at the company here, it's forecast to grow just over, 20% a year. It's not what Hims is growing at 80%. You can see here the company is still losing 300 million. The losses aren't looking to improve that much. Looking at the company's gross margins, they got 73% gross margins, which isn't as good as the gross margins that Hims have just put in. You look at the financial health of the business, it's okay, I guess. They've got nearly 1 billion in debt. You look at the cash balance, they do sit on 1.9 billion of cash. I mean, the balance sheet is okay. And then I'm looking at the likes of Hims and Hers, which is growing 80+%, quadruple the growth there. They're moving into profitability at the moment as well. You look at the balance sheet is better. There's no debt on that balance sheet, and they sit on 193 million of cash. So maybe a little bit less cash, but they've got no debt on there. So it's a clean balance sheet. So you've got a company here with, in my opinion, a better balance sheet, a lot faster growth, better gross margins, moving to profitability a lot quicker, and yet one of these growth stocks is trading at 18 times sales. And I know a few people have questions around using a price to sales ratio, but the best one I can use you for this is a bit of comparison. So it's 18 times price to sales ratio, and you look at Hims is currently a 1.97, a 1 time sales, and it's why is this company trading at 18 and yet Hims is down at 1, and yet Hims is by far the better company in every aspect? And just to put that into context, if Hims was to trade at even a 10 times sales, by the end of the year, talking about a company that is nearly 10 billion market cap. I've just never seen this before in the market. I've never seen a company smash the financials, grow their revenue, have these gross margins, have this balance sheet, on the path to profitability like Hims, trading at a low valuation. I mean, if you stick a 10% profit margin on this company and look at what, if you think they can get to I think they can get to a 10% profit margin in the next 5 years. I've just never seen a company like this at these sort of levels before. And I just weigh up, even with the risk of maybe regulation, that's the only thing, or competition, I still think like the opportunity is so good here. And I don't know, I've never seen anything like this before. And that's why I'm buying up Hims massively. I think it's a fantastic opportunity out there. And the big thing I have now is how big of a position do I make it? It's already a relatively big position in my portfolio. I think it just sits sits probably around 5th place in my US portfolio. You know, do I start putting that up to 4th, 3rd, 2nd, 1st biggest position? I don't know. So it's crazy that opportunity I'm seeing there. And last one is Alibaba. So I wasn't really planning on Alibaba in the last kind of couple of days, but I did. And the reason why is earnings. Earnings very much impressed me for Alibaba. Now, as you guys might know or might not know, I've been a shareholder for Alibaba for quite a while. I started buying shares in 2018 of Alibaba originally, rode the stock up to around 2020. I was up over 100% on my position. I sold about half my position out in Alibaba, and I thought I'm going to hold shares because I think Alibaba is still going to do very well in China the next few years. Now, that all changed in 2020, and you can see here the share price went lower and lower and lower, and it's gone to a point where I was actually down on the shares I bought in 2018, which is crazy. I didn't think we would be talking about 5 years down the line and I'd be down on those shares, but it happened, and I didn't really see Alibaba going to the point where it would be lower on a share price when it IPO'd nearly 10 years ago, which is once again absolutely crazy. But obviously they've had a few issues, maybe not their fault, maybe other fault, outside sources that maybe caused that, and we'll look at that. But I think people don't actually realise like the amount of companies that Alibaba own. They own a lot of companies. If you live in China, you are going to be at least using one of their products, and probably multiple of their products as well. Now, obviously, the reason why the stock has done so poorly is obviously China. China have cracked down on the likes of Tencent, Alibaba, and that's made life hard for Alibaba with the growth and profitability and trying to change the business model to where they do very well going forward under the environment. And it looks like most of that has now been stopped. So Alibaba can now get into a better position where they're not trying to work around these crackdown rules. And also as well, China itself, obviously the CV situation has been dealt differently in China, whereas we are more like after the first year, we were kind of like, well, we're just going to have to live with it. It wasn't really until the start of this year where China went, actually, we're going to just have to open up our economy, and they opened up the economy. So they've basically just come out of the whole CV situation this year, whereas we've kind of been back to normality for probably a year and a half-ish, maybe 2 years, you could argue, and that's finally let the kind of economy open back up, and shows you that maybe China are a little bit more supporting to the companies now, because obviously, you know, if they don't have companies that do well, obviously they have less income coming in, and China, the government, have less money to go spend on things they want to go spend money on. Looking at Alibaba as well, they're looking to restructure the business slightly. They're going to split it up into 6 units. Hopefully that gives them the ability to all the individual units to maybe shine a bit better, to get their own management, to have their own budgets, and maybe they flourish a little bit more being separate, and hopefully as well they will get better valuations being separate businesses, as people can own what they want to own as well. So if you're thinking, I just want to own the cloud platform, you can buy that separately, and from a regulation point of view, hopefully it helps a regulation point of view. So I think that's going to help them as well. But the recent earnings I thought was really solid. I think when you look at the EPS, it was a really good beat on the EPS. Revenue growth was good, 14% year over year. I think Alibaba in the longer term will grow more towards like 10%. So I'm actually pricing a little bit less growth than this, but I was really impressed with the growth, really impressed with the profitability ramp up that's gone inside the business. And obviously the share buyback, you know, this company, once again, I think people are not factoring in, like this company is buying back 6 billion in stock, which is a very big buyback that's going on, very much like a PayPal, for example, that's really going to help as well shareholders. And then ultimately looking at the valuation point of view, I'm looking with the ramp up in profitability that's now going back on inside the company. the company trades at around about 9 times earnings. And once again, I'm looking at like the historic valuations, and I know people once again will say, but it's not growing as what it used to do, and I 100% agree with that. But even then, you're looking at it, you know, relatively quite cheap. You look here, 41 times earnings, 50 times earnings, 33 times earnings, 24 times earnings, 27 times earnings, 30 times earnings, and then you go to where we're at right now, which is around, you know, 20 times earnings. But you know, within a couple of months' time, once this, like PayPal, once the profitability ramps up, we're going to be, you know, down towards the 9 times earnings. And once again, I look at that thinking, you know, obviously Alibaba being an ADR, being a Chinese company, and all the risk associated with it, obviously it's always going to be trading at a cheaper valuation to the likes of Amazon. But, you know, how cheap do you trade it at? For me, you know, that's a company that's buying back that amount of stock that's growing 14% year over year, or even if it grows 10% year over year, with, you know, if they drive up the profitability, and, you know, a major player in China in the next few years, I think it's a decent company. You know, even if you put it like the market average valuation, let's say you trade at, you know, 20 times earnings, for example, you know, even then you're talking a double up on the share price, where you're talking this company goes up to $180. And that's not factoring in any kind of growth for the next kind of, you know, 5 years. So I look at this one and I think, you know, right now at these sort of levels, I would expect Alibaba to do very well from a valuation point of view, from a growth point of view. And I think the share price potential return in the next few years is definitely in investors' favour. So I look at that thinking, I do really like Alibaba at $90, and yeah, I nibbled some shares for the first time for a while in the last kind of couple of weeks, and I'm thinking once again, it's one of the stocks that I'm looking at going through September now, and thinking that into November, when I do this video again in a month's time, you might hear from me in the next few weeks that once again I nibble at some Alibaba shares, because I think the valuation is quite attractive, especially when you look at the financials. They're definitely showing the signs of recovery at the moment. So yeah, those are the 3 stocks that I bought in the last couple of weeks. I hope you enjoyed it, and let me know what you have been buying in the last few weeks as well. And like I said, I'll do my UK one in a few days time. So I hope you enjoyed the video, and as always, if you could hit that like button, that's all I ask for you guys, for me sharing that information for you guys and putting this work in. And thanks for watching. See you in a bit.